Hello ladies and gentlemen, boys and girls, welcome once more to my YouTube channel where you are hanging out with your risk manager. I don't call myself a trader, I actually call myself a risk manager because we manage risk. Everyone can click the mouse and place a trade, but it's not everyone that can effectively, efficiently and correctly manage the risk that goes with it. So we manage risk. What we are doing here, we're going to dive into technicals, which just gives an edge. They gives us an edge. The market, I believe it is 30% technical and 70% psychological. So I'm gonna do another video during the week, just going or diving deep into psychology of the market, because people are not successful in the markets and not because of poor technicals. Like your technicals can suck, but if you got your psychology on par, you can consistently make money in the markets. Technicals just gives you the greater edge and just also ease your psychological pressure in the markets, because they make you confident, they make you feel like you're in control, they make you feel like you know what you're doing. So when it comes to your emotions, you can better manage them. But when your technicals are not in point, then your psychological is going to be all over the place. So hence, with my channel, I'm starting with technicals, and we will be throwing emotional nuggets here and there in between. So let's dive into breaking down this euro pound. I'm quite excited to break it down with you. So euro pound is looking good, looking from where we're standing, looking from the daily time frame. We are not going to focus too much on this price, because it is not a question that we broke out of this structure. Let me just pull it to the left. We broke out of this structure. What we are concerned about is that piece, is this piece of price, is what is happening here below. The question is, are we going to break back into the structure, then form a corrective channel and move up? Are we going to see this as a corrective structure to move to the downside? Then we've got 1, 2, 3. Or are we going to just move here for some time, or possibly even go back here to break out? We don't know. However, we don't even need to know. What we are interested in is what the market tells us. And what is the market telling us right now? I want to quickly remove this so that we can move on. What is the market tells us right now is that we broke below this structure, right? And we broke so beautifully in a form of natural progression of the market, and that is impulse, smaller correction, impulse, and now it looks like we're forming a bigger correction. And I'm going to tell you why I say that. I've seen this over and over. If the price was going to break down into this area or back into this area, we were going to have a sharp move like this, then correction here and break out. Or we were going to have a sharp move like this, then correction here, then continue on. Even with this impulse move, we would have had something like this as it was breaking, something like a descending channel, then break sharply to the upside. But that did not happen. Instead, how did we break to the downside? Aggressively, impulsively, and start correctively going to the upside. When we see the price moving correctively like this, we know that there's no sustainability in that move. We know there's no sustainability in that kind of movement. Soon or later, the price will have to impulse and move aggressively. So in the daily right now, we have price looking so beautiful. We are already starting with our candles committing to the downside. Let's go to the lower time frame. Let me just quickly remove this so that we have clean charts. Let's go to the 4 hours, ladies and gentlemen. Now we want signs and signs that the price is committing to the downside. We don't know as yet if the price is committing, because all we know, this can just be something like this. Then impulse, correction, impulse, then start correcting, going up. We don't know. Hence, at this level, as the price is, we cannot sell. Remember, never feel like the market is moving away without you. The market is going nowhere without you. The market is not as fast as you think it is. And I'm going to keep on reiterating that every time. Never feel like you have to chase trades. Never feel like you have to chase the market. Wait until the market confirms to you the direction. Right? And that's what we're going to do now. So now let's build evidence or a case in terms of directions that we preempt. If we look here, we came down, we left a footprint right here before we commit down. So this footprint is what we call an inflection point. That is a point where the market is likely to come and retest. When we committed down, we formed a corrective structure. The market sometimes comes and retest the back end of the structure, right? So what do we see here? We see also 3 touches. If we take our real line and just mark from here, we've got our 3 touches, or we can actually, here's the correct one here, because this is a correction on its own. It continues, then here's the first touch, here's the second touch, here's the third one, right? Now, the more the price touches, we need minimum of 3 touches. It can be 4, it can be 2, it's fine, but preferably 3. You know, the 3, minimum of 3 gives a little bit of more weight in terms of this ascending channel to break to the downside, right? Every time we see an ascending channel, we know that one or the other, the price has to break to the downside. So we see from this inflection point, we had a price that touched here but did not come all the way here. Price came here and did not come the way here. Price touched here. Ultimately, we needed a break and come back. And if you look at the break, this break is incoherent with the back structure of this correction. This is incoherent of the previous low here. This is incoherent of this here, this here. So what it does, it just gives more gravity to the probability of this trade working out, or the probability of this price moving to the downside, because we don't have a trade as yet, right? So building our thesis, building our case, let's go to 1 hour. Now we are looking at the opportunity. We determine that we are in an ascending channel. We know that ascending channel has to break out, but also we know that it can always do this and go back here. So we cannot just take a trade here prematurely. We cannot take a trade here prematurely. We are managing risk first, risk managers, before we place any trade. So what must we look at now? How are we going to get engaged in this? We have a clear commitment, number 1. The beautiful thing about that is that it cleared this flow. So we won't have something like this from here, right? It cleared this low and is in line with this previous high here, and yes, so far, right? Now, what we can look for, let's measure this impulse using Fibonacci retracement tool to our 50%. Here's our 50%. What we can look for is correction to the 50% mark. Come down, correction, and we can get involved here, or even involved here from the first touch. Because we don't know if the market is going to move from the first touch or the second touch, right? So we can get involved as such. So why using the Fibonacci? Normally, after an impulse or the price is committed in self-forming impulse move, it will normally move or retrace the 50% of the set move. So, and if you look at the 50%, is also in line with this beginning of the gap, with this high of this gap, right? Let's clear that. So we can do this. Let's go to 15 minutes. We can now mark our 50%. It's just beautiful because if you look at this 50% mark here, we had a small correction impulse, small correction to this mark, commitment, small correction commitment, right? We're gonna have to have a larger correction now comparing to this one here, comparing to this one here. So we can now start planning our trades like this. Now we are using this type of entry which we call insurance entry. Insurance entry is to mitigate risk, is to enter the market when it has shown that it is committing or it has committed. It is committed already, right? It is committed already. Looking at this, it is just taking a break. Where it takes a break, that's when we enter. Then we get committed with it in the next leg. So this is how we can play it. It's beautiful risk reward. You are protected above the structure. 8 pips, yeah, 8 pips, which is beautiful because it puts us above this, it puts us above this, so we are kind of protected. And the potential to the downside is great. Look at this. Just this move alone. You don't have to be in and out of trades every day, every hour, and all those kind of things. You just need to be patient. That's all you need. You need to be patient, and one trade can reward you greatly. Patience, you have to learn to utilize patience as a tool, as a weapon. Let's utilize patience effectively as a weapon, because there are people, I've seen people that get so much patience, and when they get to the set levels that they've been waiting for, then they just become impatient and reckless and take premature trades and lose money in and out unnecessarily. So let's not become patient to be impatient. You know, you waited all the way until the price got to this level. So why do you just want to jump here and jump here in, jump in here? What if it gets here, then it goes like this? Then it was, let's do this. You'll find that it was just forming this structure to move to the upside. Yeah? We don't know. So wait for a clear sign that, listen, I'm committing to the downside, right? Then you can take it. So this is how you can play it, ladies and gentlemen, boys and girls. So I hope this helps. Let's be sober, let's be vigilant, and let's be patient. Learn to weaponize patience, right? Let's move to one of the pairs that are looking good in my watch list. If you go to the daily, it's Euro Aussie. Euro Aussie or Euro Swiss, whatever you prefer to call it. If you go to the daily time frame, the other thing, sorry, before I continue, the other thing is that you want to take pairs that are properly positioned, right? You don't want to take pairs that are poorly positioned. You have to filter them accordingly. So if you look at this one, it is perfectly positioned. Why am I saying that? We broke this low. We are trading below this low. So we are looking for continuation of this move, right? As we said previously, remember the market moves in impulse, correction, impulse, correction. That is the nature of the market. Sometimes the correction is not so clear. It can be like this and calm. You just stay off those ones. You want to look for the ones that are moving with natural progression. They're cleaner, you will find good setups. Okay. So if you look at the day, it is clear that we are trading below this, right? This has been cleared, this has been cleared, we are here. So, and by looking at the nature of the price itself, it is telling us that I'm correcting, right? We don't know how far it's going to correct, but whenever we see opportunity, we will sell. So let's go to the smaller time frame. If you come to the 4 hour, we see here we have the price that is tested the back end of this corrective move right here, right? It near miss, we've got a space here, it comes and fill, break and comes back. Now the reason I love the breakouts and retracement is that it does two things. Number one, it wipes out the stop losses and the filters orders above them. Number two, it reiterates that the fact that buyers could not push the price up. There is selling pressure in this level, so it is a confirmation for us. So if you look at the 4 hour, we broke down, we committed in this 4 hour, right? We do not get involved, we are not part of the commitment. However, we can still get involved. I would have loved to be involved somewhere a little bit higher because of the type of price action that I see here. This one is not the same as that one. That one was the one of Great British Pound, Euro Pound. It was a bit steepy, right? Number one. Number two, it did not have a base like this one, right? So this one is a bit different because it is flat. It has a base that it formed. So because of that, we can manage to take things like our risk entries here, right? However, I missed my entry. I would have got in here after this retracement. However, I did not, but we can still get involved. We had our impulse. We are looking for our correction to the downside, right? Let's go to the smaller time frame and see what we have here. Here we are. We have our impulse here. We have, let's take a Fibonacci retracement tool and see how far our impulse. Beautiful. We don't want our corrective structure to be over 50%, right? Corrective structure must be within the vicinity of 50% because it cannot be more than 50% of the impulse itself. Then is invalidated. We move on. We look for other opportunities elsewhere. As long as it's within the 50% mark, beautiful, right? So here we are. We have a touch here which comes to the back end of this. We see we clear this, but we have a break and a retracement, right? Let me just do this. We have a break and a retracement. I would want to see a 15 minutes candle that comes and closes below here, right? If it closes around here, then I will have my sell. I can take my sell. In fact, what I'm going to do, I'm going to put a limit order around here, a sell limit order. Then we can have a protection here, 18 pips. If we want perhaps to put it upon or over this, which is unnecessary. Once it gets here, then it means that this trade is no more. It's not committing. So there's no need to say I'm going to put my stop around here. No, you might as well put it around here. So it doesn't make sense. So if it breaks here, this level, and commit, then I might as well be taken out here. If it comes back and recommit back into the structure, then I can take another sell here, and it's fine. I take 1% loss. I can go again. I'm taking a 1% loss for potential of 5-6%. So I can never hesitate when I see opportunities, right? There can never be any hesitation. So I would love to see this loss cleared, then we can have an opportunity like this. 18, 19 people stop all the way to the low, not even to the low, but yeah. 4.6, and we are looking ultimately, remember, this is just in the structure, we're looking for a breakout, 9-10%. So this looks beautiful, boys and girls. Now we come from here, right? Impulse, small correction, impulse, little bit bigger correction, and we're expecting another impulse. So let's take these opportunities. Let's not be impatient, let's not be reckless. We are risk managers. Remember what the market has done, or what the forex, non-forex traders have done. They've taken the quality out of forex trading and make it look like a gambling. Forex trading is not gambling. You have to manage risk. You're a risk manager. You have to risk 1% or below or lower. You cannot risk 20% of your account on one trade, that percent. We don't know which trade is going to work out, which trade is not going to work out. It's a matter of probabilities. It is probable and it is possible. So even if I take a loss which is inevitable, it must be that I lose an amount that does not shake me, right? And I must trade in a manner that if I take my account and show an investor and show him how I trade, the investor can be confident and sane and settled with his money when I'm trading it. So some of the way these people trade, they cannot take money and give it to, so the investors cannot take the money and give it to them and say trade for me, because in one trade that account, should it become a loss, it will be minus 40%. So would you take your money and give it to someone who risks 40, 50, 60% per transaction? I wouldn't do that. So let us be sober, let us trade professionally and become the vision of what we want to be. Let us trade in a manner that we want to be 5 years, 10 years time. So I hope you enjoyed this video. I hope that you learned one or two things, and I hope that you shout at me in the comment box if you've got anything to say, a question. I will respond. So enjoy the rest of your day. Cheers. Thank you. Bye.